Hi, I'm Tom Stevenson, and welcome to Construction Business Management. Today we're going to be looking at a case study on the income statement. If you haven't watched the previous videos, in the description I'll leave a list of links, and please subscribe and you will see under the playlist Construction Business Management all the different lectures if you want to follow through the whole course. But today we're going to be looking at a case study and trying to come to a better understanding of markup in particular. In the previous lecture we looked at the income statement and the different components of the income statement. So our construction case study today is Last Chance Constructors, and they projected some key numbers for their income statement. Now what's important is that you kind of know what the components are for an income statement. And if we're talking about for the year in this particular case, so we're saying total sales, that would be what they're selling their projects for and the total of all their projects that they project that they're going to get in the coming year. Now, part of the thing that is involved in projecting is kind of looking at what happened in the past, but also looking at what prospects they have in the future and then what kind of goals that they have. And this ties to the overall business plan of marketing and trying to procure more business and how much you're trying to scale up the business. So these things all kind of tie together as a bunch of nodes and networks that when completed gives you a pretty good idea of what you need to do and what you need to prioritize in your business. Going back to what we've said in previous lectures, we're trying to work on the business. We all know construction people work very well in the business, at least the good ones do, and they're really focused on doing their projects. But unfortunately, the part that gets left out is understanding how their business is actually formulated, where the opportunities are. Are they making money? Are they losing money? Are they charging enough? All of these things come into play. So the income statement is very helpful for that, and understanding markup is very important. So your income statement really shows total sales, in this case your projections for the year, your direct costs, what the actual projects cost for you to actually construct them, the direct labor, the subcontractors, all the materials, all the setup stuff you need for the individual projects. And then you know what? You have your overhead. And don't forget about your overhead. If you're a small business, you're running around pricing jobs in the evenings and on weekends, that all takes time. There should be a cost allocated for that. If you're a mid-sized business or a big business, you know you have people that are hired to do other roles and they may never step foot on the job site. You know, you might have estimators that are estimating the jobs that you're pursuing and trying to get. You'll have administrators that are maybe in charge of accounts receivable, accounts payable. You may have other aspects, marketing department, other things that you're trying to pursue and you're trying to include in your overall business. So all those things are going to come under overhead, plus your office and your other costs such as your cell phones, your vehicles. All these things would come under the area of overhead. And then, of course, we want to eke out a profit in this industry, right? So in the previous lecture, we looked at profit and we said, you know, you might be at 8 to 10%, but it also depends on the risk level and the types of jobs that you do. You know, if it's a cost plus type job, it might have a lot less threshold or premium for profit just because there's less risk. If it's a lump sum with liquidated damages, it should carry a bigger premium because you're taking on a lot more risk. So those aspects, but we've got to have a target for that for our business. So we're in this particular case, Last Chance Constructors, they have yearly sales for the upcoming year of $900,000. They have overhead for the upcoming year of $125,000. Now, if you already have certain things, like certain people in certain roles, you can get a pretty good idea of what your overhead is. And of course, if you expand and you hire on a new person, that adds to your overhead costs. So proportionately, you better be adding to your sales. If you're not, then that extra person you hired is going to be eating out your profit. So that money would be basically, overhead would be expanding and profit would be diminishing if the pie itself, total sales, the pie itself is not getting bigger. So you can kind of look at it that way, that you've got this fixed pie. So much is for direct costs, so much is for overhead, and so much is for profit. So if you decide to get extra vehicles or a more fancy office, or you hire somebody and that pie doesn't get bigger, then you're going to have a problem, right? Because you're extending that overhead in that way. So it's good to, the part of this exercise is trying to understand the different parts of the pie and how they relate to each other. So yearly sales is projected at 900,000, their overhead 125,000. And if we say their target is 10% profit based on sales for the coming year, that would be based on this amount. All right, so they're saying the profit would be 10% of this overall amount. And you can kind of look at this and you can kind of see, well, if I know this and I know this and I can figure out that, then if I add them together, I should be able to come up with this, right? So it's just how you're adding and subtracting between the different components. So some questions we should be able to answer from our case study here, which I just posted on the next few slides here, so we can always refer to it without having to go back in the video. What is our percentage of projected overhead for the year? It'd be nice to know, what is our percentage of our overhead overall? And what is our projected profit in dollars? That's pretty easy. If you're pretty good at math, you just look at that, 10% of that, 900,000, you can do the rest. I've got it on a slide coming up. What are our projected job costs for the year? Well, sales minus profit plus overhead. What I really want you to do is sort of understand how these components work together, and you can shift them around depending on what it is that you're trying to figure out, right, using basic algebra. But of course, if we know our profit in dollars and we know our overhead in dollars and we know our sales in dollars, then what's left is our job costs. Really what you're doing is you're just saying, okay, I know this and I'm going to subtract this and this, the sum of this, and that will leave me with that. What should the sale price be for a basement renovation job for the Smith family be? All right, so your takeoff for this job has a cost of sales of $30,000. So you have a direct cost of sales of $30,000. That means your materials and your labor directly for doing that work is $30,000. Well, that doesn't mean that that's what we charge for that project. What are we going to mark it up? And when we mark something up, we're marking it up so that we can cover our overhead and our profit. And then that should become the sale price for the actual project. So markup times cost of sales for the project. So markup is going to be a percentage number. Cost times cost of sales for the project equals the project final price. So these are formulas that you can look at that are helpful. This one's very helpful for figuring out what your markup should be. This one's very helpful for figuring out what your project final price should be, knowing what your markup should be. So overhead divided by projected sales. So we have 125,000 divided by 900,000. That gives us 13.889 or 14%. I would typically round up. That's giving us, even if it was like 13.4, I would likely round up, or I would keep it at the 13.4. Never round down, because this is giving you a little bit more money. Anything going lower gives you less. Basically, this number provides you with the data of how much your business spends on overhead in a year. When you do a 5-year income statement projection, and part of this course is putting together a business plan, and if you're doing a projection on the income statement, it'll be useful to see if your overhead costs are going up or going down over that period. Now, if your overhead costs are going up, that's not necessarily a bad thing if your business, your sales is going up as well. And overhead doesn't always have to go up proportionately to sales. Sometimes, you reach a certain zone with your overhead, and that's enough to estimate the projects you're getting, to pay the rent and have space to work in the office. Then you usually hit a certain wall when your business gets bigger that you don't have enough space for the extra people you want to hire. You need another estimator, and that's going to have an extra cost on it. And so there's usually, when you make some of those expansive costs, it increases your overhead. And sometimes your sales don't go up quite as quickly as you would like. So you actually end up maybe reducing your profit a little bit over the next year. That's okay if you understand the numbers and you understand that, well, you're just working through this to get to the next level. When you get to the next level, then there might be extended growth in your profit. On the other hand, if you're adding these things and you're not increasing your total sales, then that's a problem, because that means that you're kind of stuck and now you're making less than you did before. You got to take some corrective action. That's part of why you want to have a vision. That's why you want to have goals. That's also why you want to have systems built in so you can monitor your progress and you can basically do tactical, strategic changes as you go. And we talked about strategy and tactics earlier in the course in one of the earlier lectures. And again, I'll have those lectures in the descriptions. And if you subscribe and you click under the playlist for the Construction Business Management course, you'll see the other lectures. So if you have exceedingly high overhead costs, it can make it difficult for you to compete with rivals. That's the other thing. That should be it. But it makes it difficult for you to compete with others or rivals if you have a lot of overhead, because now you've got to charge for that in your pricing. And if you're not charging any pricing, you got a problem. And if you are charging it, you might have a problem because somebody's got less overhead, so they can still maybe have a lower price and get projects from you when you're going bidding on projects based only on price. So you have to be conscious of those elements as well. So it's good to understand what these numbers mean and then to sort of check the pulse of them as your business is proceeding. What is our projected profit in dollars for the years? Like I said, that was pretty easy. You look at the 90,000 times 10% or 0.1, that gives you $90,000, right? So we've solved that one. What are our projected job costs for the year? So we take that formula that I had earlier, total sales minus overhead plus profit. Well, we were given the overhead because we would have figured that out, the cost of all of our rent, the cost of, like our estimators and admin staff, all of those things. For the year, the projections for that. If we're doing it as an actual, then we can just look at those numbers, what they were. Plus profit, which we just said was 90,000. So we take 900,000 minus here we've got 215,000, and that's going to give us 685,000, right? So that's our job cost. So now we know, going back here, we know all of the numbers, right? We know all the numbers. Gross income is simply the addition of the overhead and the profit together. That's your gross income, also referred to as gross margin. So we figured that out. Then the next thing is, what is our current markup, right? So we take our total sales divided by our job costs, and that'll give us our markup. So 900,000 divided by 685, that gives us 1.314. If I round it up, like I said, just to round it up, that gives us a 32% markup, right? Or you could leave it at that number. 32% markup. In essence, this means you have a 32% markup on job costs. So whatever your job costs are, you're going to multiply it by 1.32, and that's going to give you your sale price. Or you're taking your job costs, you're figuring out what 32% of that is, and then you're adding that to the job costs. So either way, that's how you're to do it. So job costs times markup, and that's usually easiest. Just take that number that you had there before and just plug it in. 1.32 times 30, 39,600. That's a big difference between $30,000. And a lot of people that are starting out in business, they don't mark things up enough. They don't understand what their costs are. Or maybe they start out that they're working out of their apartment or something like that, and they don't have a lot of overhead, so they don't consider it. But you know what? That vehicle that they're driving around in, it's wearing away. Every kilometer, every mile that you drive that vehicle, a little bit of it's wearing away. And so that is a depreciation on that vehicle. You're going to have to buy a new vehicle at some point. That markup is helping you to raise those funds for that wearing around off of that vehicle. That's not supposed to be coming out of your savings that you made from paying yourself a wage in running this business. So In the big scheme of things, this means that if you price your jobs in the coming year this way and your projections are correct, you'll cover your overhead costs and make the desired level of profit. Now, of course, if you don't get enough sales to meet that target, then you're going to be short. And if you actually end up with that same overhead, that will eat into your profit. That'll lessen your profit as well. So you got to be conscious of how that works too. It doesn't mean you're free and clear. You still got to, these projects have to add up to this amount over the year that you projected based on what your overhead costs. So there's this interrelationship between all of these elements. And I think it's just getting a handle on the numbers and getting a pulse on it. Now, of course, if you keep your overhead the same and you're able to have more sales in the years, bonus. That's going to be really good for you, right? That's going to really add to your profit. So it's having a good understanding of how these numbers work together that can work well. Now, the other thing I just want to caution you about when we talk about markup is, you're always going to have people that want to challenge you on the price and want to reduce the price. And I mentioned this a little bit in the last video. You got to be careful because I'm telling you, every dollar that you lower off of that price is coming off of your profit. So in a project like the Smith residence, right, if we really, in that markup that we had, the markup is including our overhead and profit, and we had allocated for 10% of profit, you really only have $3,960 allocated for profit on this project if we look at this number, right? Because this is how we arrived at it. That's that 32% that we got was based on markup, which is including both of our overhead and profit. It's a multiplier to direct costs. And I just want to also clarify, because new people that are looking at running a business, they get confused a little bit with overhead and profit. Gross income, well, that's the same as markup. Now, markup is the multiplier that you use on the cost of sales, right, to get you to the total sales amount. These are just dollar amounts, overhead, profit, and this added together that. Cost of sales is the multiplier that you're going, the markup is the multiplier that you're going to multiply cost of sales with, that 1.32. So that 132%, basically all you're doing is you're multiplying the number itself, right, when you get into the job, the 30,000, so it's just keeping that there, times and adding the 32% markup, not adding, but multiplying. 1.32 equals 39,600 when we multiply that. So that's got our base amount, the job cost at the end of the day, plus our overhead and profit as the multiplier. So I can easily see then 39,600, that's $3,960 profit. Now you get some smart client that starts asking you a lot of questions and wants to cut the price down. You end up cutting $3,000 off that price. You're only getting $600 profit on this project then. Are you in business to only make $600 profit? I don't think so. Right? So you want to make sure that you've allocated enough for your profit, not to mention in that direct job cost amount, you should have had an allocation for management contingencies and for project contingencies that would occur. One is for the unknowns that occur, and the other is for just little variations that you would have. So you also want to make sure of that part, that's in your costing as well, because nothing goes exactly as planned. We've mentioned the planning fallacy. You have to be conscious of that. All right, so we have that, and what I really want to emphasize then is be very careful not to lower your price without lowering what you're providing. It's okay, yes, we can do it for $36,000, but in that case, we won't go with the granite countertop. We'll go with this nice laminate instead. There's your $3,000. So you're looking for something that you can barter with or negotiate with. Don't just be dropping your price unless you know that you've got a little bit in there that's still going to leave you with 10% profit at the end of the day. You have to be very careful of that. New people in business often make that mistake. They cut down the price, and then they have remorse later on. And the Warren Buffett quote that I like to think about, rule number 1, never lose money. Rule number 2, never forget rule number 1. Pretty good idea. Pretty good concept, pretty simple. Warren Buffett always comes up with pretty straightforward, simple. It seems like it's logical, but it's not always practiced in the world of business. So you have to keep that in mind. And I do a lot of consulting with construction businesses, and I know that very often there might be 5 really good projects that they have that are very profitable, and then there's one that's a complete mess. It's fortunate that they have the 5. They remember the one very clearly. It's usually the talk of the company, this one project where it's $30-40 million over budget. Yes, I said $30-40 million over budget. There's lots of construction projects that are large. They're not small ones that are 30-40 million, that are large, that go south. And that 30 or 40 million, that usually takes 2 or 3 of the good projects' money. So you end up only with the profit from 2 out of the 5 other projects. And they better be good because that's got to round out the overall business. Well, what if we could do this, that we don't have 1 out of 5 that are a mess like that it's 1 out of 20? Then it's a much smaller amount. And that's the continuous improvement aspect. That's the way contractors need to be thinking. And that's the way we need to think in the construction business. We need to be thinking lean, continuous improvement. And if we're developing a business, we need to develop a business with that in mind. Reflective question, although profit levels will vary among companies, as a guideline, industry statistics show that most construction companies strive for 8 to 10% net profit. This number is open for discussion. I'm just throwing that out there. Like I said, it can be less, it can be more. If you're a development company, and we'll talk about this later in the course, you're looking for higher ROI, return on investment, but your money is kind of leveraged in those examples, and that's different than profit. But there's different ways that we look at the data. And I did mention that construction management contracts, where you're not at risk, again, the profit levels will be tighter. But that's okay, because now you're working on total dollars, and you typically don't have that 1 in 5 projects. That's a disaster in that case. It's not there. So you've mitigated that risk. And a lot of contractors try to focus sometimes a certain amount of their business that way, or some contractors, that's what they want to do. They don't want to do the other side. And others, they like the other side. They like that risk aspect because they feel that they can be really productive and they can win on the margins. So think about examples of where risk levels may vary in different sectors of the construction industry and why this may or may not affect profit margins. And so you think about some of what you know about the construction industry and the different sectors, and compare and contrast that. Maybe compare small renovations to large infrastructure projects. Compare commercial institutional projects to heavy industrial projects. It's just something to think about and ponder how the different construction businesses operate within the different sectors and some of the different risk levels depending on the types of contracts that you enter. So hopefully that's given you a good sense of the markup aspect and how the income statements, the components of the income statement, work together when we're talking about job costs, overhead, profit. Overhead and profit is your gross income, and altogether they add up to our total sales. I find it's very helpful to just picture that little bar there and how it's broken up. I think that if you can draw that out, then you can picture it in your mind, and then when somebody's throwing numbers at you, you can kind of see it after a while. When you're in business long enough, you see it, trust me. So I'm Tom Stevenson, wishing you a wonderful day, and we'll see you in the next module. Bye for now. Oh, and don't forget to click subscribe and look under the playlist Construction Business Management for the rest of the videos. Bye for now.